On March 3, 2026, while American drivers stood at gas pumps in Phoenix, Atlanta, and Cleveland watching the cost climb past $5.10 a gallon, President Donald Trump opened his Truth Social app and typed 17 words. The United States is the largest oil producer in the world, by far, so when oil prices go up, we make a lot of money. He was not wrong. Within hours of his post, Brent crude futures pushed above $107 per barrel. Tankers sat dead in the water around the Strait of Hormuz. But on the trading floors of Houston and inside the corporate towers of Exxon, Mobil, and Chevron, executives were watching their stock tickers light up green. By the time the first month of fighting was over, a single sector of the global economy had quietly collected over $23 billion in pure windfall profit. This is how big American oil became the biggest financial winner of the Iran war. To understand the scale, you need to go back to early February 2026. At the start of the month, a barrel of Brent crude was selling for around $73. Diplomats from the United States, the United Kingdom, France, and Germany were meeting Iranian negotiators in Geneva to discuss uranium enrichment limits. The Strait of Hormuz, that narrow ribbon of water between Iran and Oman, where roughly 1/5 of the world's seaborne oil moves every day, was operating at full capacity. 20 million barrels of crude flowed through those shipping lanes daily, mostly headed to refineries in China, India, Japan, and South Korea. Then, on February 28, 2026, everything changed. American B-2 bombers and Israeli F-35 fighters launched a coordinated air assault on Iranian nuclear and military targets. In the first wave of strikes, Iran's supreme leader Ali Khamenei was killed. Within 48 hours, the Iranian Revolutionary Guard had laid sea mines in the shipping lanes of the Strait of Hormuz. By March 5th, the international war risk insurance markets that underwrite virtually every commercial tanker on Earth simply withdrew coverage from the Persian Gulf. Without insurance, no shipping company would risk a tanker worth $400 million on a passage where the cargo could be vaporized by a drone worth $5,000. More than 1,600 vessels and 20,000 seafarers were stranded inside the Gulf, unable to leave. Goldman Sachs analysts ran the numbers and arrived at a single, devastating conclusion. This was the largest oil supply shock ever recorded in the modern era. Worse than the 1973 OPEC embargo, worse than the 1979 Iranian Revolution, and worse than the 1990 invasion of Kuwait. Persian Gulf crude exports collapsed from 20 million barrels per day down to around 600,000 barrels per day. That is roughly 3% of normal volume. JPMorgan Chase calculated that 13 million barrels of daily oil supply had effectively been removed from the global market in 1 week. That is more oil than Iraq, Kuwait, and the United Arab Emirates produce combined. So the price climbed. Brent crude opened the morning of March 1st at $82 per barrel. By the closing bell on March 3rd, it had crossed $100 per barrel. Within 2 weeks, it had spiked above $119 per barrel. By late March, traders were briefly paying $126 per barrel for crude that had been selling for $73 per barrel only 1 month earlier. This is where the real story of the Iran war begins. In the global oil market, the mechanism for converting a supply shock into corporate profit is automatic and almost invisible. Oil produced in West Texas is priced against the same global benchmark as oil produced in Saudi Arabia. When Saudi crude can no longer reach customers in Asia, those Asian refineries do not stop buying. They simply pay more, and they pay it to whoever still has product to sell. American producers, sitting on top of the largest shale formations in the world, suddenly found themselves selling every barrel at a price 70% higher than what their internal models had assumed only weeks before. Climate watchdog Global Witness, working with data from energy intelligence firm Rystad Energy, ran the analysis for The Guardian. The pure windfall, that excess profit attributable to the war and nothing else, came out to $30 million per hour. In the first 30 days, that came to $23 billion in pure windfall. Oxfam International later calculated that the 6 biggest fossil fuel firms on Earth, Chevron, Shell, BP, ConocoPhillips, ExxonMobil, and Total Energies were now earning around $3,000 in pure profit every single second. But what happened next, when Exxon and Chevron released their first quarter earnings on May 1st, would surprise even the analysts who had been tracking these numbers from the start. On the morning of May 1st, 2026, ExxonMobil reported first quarter net income of $4.2 billion. That number was dramatically lower than the $7.7 billion the company had reported in the same quarter of the previous year. Chevron's headline number told a similar story: $2.21 billion in net income. Wall Street commentators initially called the numbers a disappointment. Headlines on financial news sites ran with phrases like "big oil profits tumbled during the Iran war." But buried in the footnotes of those same earnings reports was a different story entirely. ExxonMobil disclosed something called derivative timing effects totaling negative $3.9 billion. These were not real losses of cash. They were accounting paper losses caused by hedges placed at pre-war prices that would later unwind in subsequent quarters. When ExxonMobil pulled out the timing effects and disclosed its true underlying earnings, the number was $8.8 billion. That was not a decline from the prior year. That was a substantial increase. The company's energy products segment, the division that refines and sells gasoline, posted a paper loss of $1.26 billion. But once the timing effects were stripped out, the underlying profit of that segment was $2.8 billion. The year before, in the exact same quarter, the same segment had earned $856 million. That is more than triple year over year. Chevron's own corporate guidance acknowledged that its upstream segment, the part of the business that pumps oil out of the ground, would benefit from higher commodity prices by between $1.6 and $2.2 billion compared to the previous quarter. Both Exxon and Chevron beat Wall Street estimates. Then came the projections for the rest of the year. According to consensus analyst estimates compiled by CNN, ExxonMobil's second quarter earnings are expected to more than double from a year ago. Chevron's second quarter profits are expected to more than triple. If those forecasts hold, 2026 will become the most profitable year for American oil giants since 2022, when the war between Russia and Ukraine drove average United States gasoline prices to a record $5.02 per gallon. The financial press now had a clean phrase for what was happening. They called it the Iran terror premium. The Iran terror premium had a particularly profitable shape for American producers. Because the closure of the Strait of Hormuz hit Persian Gulf exporters like Saudi Aramco much harder than it hit Texas drillers, the relative position of American oil shifted overnight. The Permian Basin, that 6.76 million barrels per day powerhouse beneath West Texas and New Mexico, became the single most strategically valuable piece of real estate on the planet. Energy research firm Rystad Energy projected that American oil producers were on track to gain $63 billion in additional cash flow this year alone. ConocoPhillips, Diamondback Energy, Devon Energy, ExxonMobil, and Chevron all sat directly in the path of that windfall. But the most disturbing element of the story emerged not from corporate earnings reports, but from a Financial Times investigation into oil futures markets. According to Financial Times reporters, more than $500 million in oil futures contracts were placed by unidentified traders in the minutes before President Trump posted on Truth Social about productive conversations with Iran. Those trades suggested that someone with advanced knowledge of the announcement was positioning to capture the price swing. Andrew Feinstein, the British journalist who has spent 2 decades documenting the global arms trade, told Middle East Eye he had never seen war and conflict manipulated so nakedly for short-term profiteering. Most striking of all, he noted, was that there was little attempt to hide it. The war is not over. Even if the Strait of Hormuz reopens tomorrow, the International Energy Agency has warned that shipping logistics will take months, possibly years, to return to pre-war levels. That means the elevated oil prices and the elevated oil profits are largely locked in for the rest of 2026 and well into 2027. The board members of Exxon Mobil and Chevron in their corporate towers are quietly preparing for what may turn out to be the most profitable two-year stretch in the history of the American oil industry. None of them planned the war, but all of them are getting rich from it. The next time you stand at a gas pump in Phoenix or Atlanta watching the cost of a fill-up climb past $100, remember this. Every dollar you pay above the pre-war price is, in the cold mathematics of global oil markets, being transferred almost directly into the corporate earnings of a small handful of producers in Texas. President Trump was not exaggerating when he posted that the United States makes a lot of money when oil prices go up. He just left out one detail. Most Americans are not the ones making it. If this kind of investigation into the money trail behind major conflicts is something you want more of, the channel covers it every week. Subscribe now so you do not miss the next one.